Hello, everyone. The topic of our group project is the unconventional monetary policies in the US. Our group members are Cao Xin, Fan Zherui, Huang Zhaohen, Miao Jinghui. There exist many types of unconventional monetary policies. Our group chose 6 of them to further discuss: commitment effect, special loan, qualitative easing, quantitative easing, negative interest rate, and forward guidance. The outline of our presentation is as follows. First, I will introduce the 3 unconventional monetary policies, and then Cao Xin will introduce other 3, and Miao Jinghui will talk about the influence of unconventional monetary policy in the US. And finally, Huang Zhaohen will deal with the cause and effect of quantitative easing in the US. I will start my presentation with the commitment effect. Commitment effects means that the monetary authorities provide investors with a clear commitment to ensure that short-term interest rates remain low for a considerable period of time. Commitment effects are generally divided into 2 types: conditional commitment effects and unconditional commitment effects. From practical experience, it is usually a conditional commitment effect. That is, the monetary authority promises consumers and businesses that the monetary authority will not withdraw from loose monetary policy until it achieves a certain goal of economic recovery. The commitment effect enables people to accurately judge the monetary policy of the monetary authority in the future and increases the symmetry of information, thereby providing a reference standard for individual behavior choices. Under the commitment effect, consumers or enterprises are convinced that the long-term existence of short-term interest rate will inevitably lead to a decline in market long-term interest rate. Therefore, the commitment effect can improve people's expectations of deflation, prevent real interest rates from rising, thereby avoiding delays in consumption and expenditure, and thus stimulate increased demand. Special loans are those in which the central bank provides loans directly or indirectly to specific financial institutions, enterprises, or other investors under conditions of normal credit function in the financial system. In the case of commercial banks' lending capacity or willingness are damaged by the impact of the financial crisis, it will be more effective to provide credit directly to investors through the central bank. The move could also send a strong signal to market participants that the central bank will do its utmost to recover the economy. However, on the other hand, such intervention will cause the central bank to bear a lot of credit risk, and in some cases, it will distort the relative price of the credit market, which may damage the profitability of commercial banks and bring benefits to some institutions and some damage to other institutions. Qualitative easing policy is to change the proportion of various types of assets held by the private sector to affect the relative prices of various types of assets, thereby affecting the real economy. The difference between qualitative easing and quantitative easing is that quantitative easing expands the monetary base in the market. The focus is on the data. It plays a role by affecting changes in the level of excess deposit reserves of financial institutions. The nature of qualitative easing policy is that the total assets of the central bank are basically unchanged, and its assets portfolio changes. Generally, it is due to the purchase of assets with poor liquidity and high risk in the private sector, which makes the central bank's balance sheet change in asset portfolio. In the process, the proportion and relative price of various assets held by the private sector also changed. Even if the nature of qualitative policies will expand the size of the balance sheet in some special circumstances, the focus is on the asset side of the central bank rather than the liability side. In practice, the purchase of government bonds or private securities by the central bank is generally regarded as a quantitative easing policy, and the purchase of private assets, such as toxic assets, by the central bank is considered as a qualitative easing policy. Next part, Caoxin will talk about other three types of unconventional monetary policies.
Hi guys, this is Caoxin, and we are talking about unconventional monetary policy today. Let's switch to the PPT page. For this part, I will talking about three more different unconventional monetary policy. Sorry, the next page. Yes. The first one is quantitative easing, as we call it QE. The second one is forward guidance, and the third one is negative interest rate. Before I start my presentation, there is a brief introduction. Unconventional monetary policy is usually used as an emergency move to deal with an uncontrollable external financial crisis. For the general economic downturn, the effect of interest rate cuts is inefficiency, so central banks have to choose to use unconventional monetary policy to directly inject liquidity into the market. Now, let's talk about quantitative easing first. In this part, I will talk about what is QE, when we use QE, and how QE work. I will not go through deeply right now, since my teammate will cover it next section. Let's see first question, what is QE? According to my own understanding, QE can consider as an indirect printing banknotes. Central bank purchased longer-term securities from the open market in prefer to increase the money supply and encourage lending and investment. Furthermore, when and why we use QE, quantitative easing meaning refer to the intervention of the central bank after the implementation of the zero interest rate or near zero interest rate policy, the start of the multiple unconventional monetary policy including QE in which target interest rates are no longer effective. QE increased the money supply by purchasing assets with nearly create bank reserve in order to provide banks with more liquidity. In the end, how QE works. After central bank purchase bunch of the long-term security, they send a large amount of liquidity fund into the market to encourage spending and borrowing. Now, I assume we should have a general concept of quantitative easing, but the scope of the application of QE is very broad and have been used for a while. We will specifically analyze the case of the United States using QE to solve the 2008 financial crisis in the next section. For the next part, we will talk about other unconventional monetary policy forward guidance. I list three core elements about the forward guidance. Let's see each of them. Forward guidance, which is the central bank provide investor with a clear commitment to ensure that the short-term interest rate remain low for a long run. Under the forward guidance, the central bank promise market that is will not withdraw low interest rate policy until a certain goal of the economic recovery is achieved. A primary motivation of the forward guidance is to reinforce the central bank's commitment to low interest rates, which may help push long-term rates down. This policy helps investors to predict the monetary policy in the future and increase the symmetry of the information. It has been helpful in reducing uncertainty about the economic and financial outlook. In the end, the long-term low interest rate will stimulate markets consumption and investment. For the real event, during the 2007 through 2009 financial crisis, the Federal Reserve made an unconditional commitment to ensure that interest rate will continue to stay at the zero interest rate boundary. In my last part, we were talking about the really unusual, unconventional monetary policy we called negative interest rate policy. This policy, in which nominal target interest rates are set with negative value below the theoretical lower boundary of the 0%. During the deflation period, investors will hold money instead of spending and investing. The result is a collapse in aggregate demand, which leads to price falling even further, slow down the real production and output, and an increase in unemployment, of course. Expansionary monetary policy is usually employed to deal with such economic stagnation. However, if deflation forces are strong enough, simply cutting the central bank's interest rate to zero may not be sufficient to stimulate borrowing and lending. Under the negative interest rate, central bank imply that instead of earning interest on money deposited in the bank, people would charge by their bank to deposit money. Just flip. So for this policy, central bank want to encourage people spending and investing instead of holding the banknotes, and it is also to be an incentive for banks to make more loans. For real events, just right now, the U.S. President Donald Trump has suggested Federal Reserve to use the negative interest rate policy, allow the U.S. government to refinance its $22 trillion in outstanding debt. In this page, I draw the ASAD curve to describe how we describe forward guidance. Since the government will assure that the interest rate keep low on the long run, so I assume it will stimulate the consumer to make more consumption, and the aggregate demand will shift to the right side. The price level and GDP will be increased, hopefully by this policy. In the last page, the controversy of the negative interest rate stance. We're talking about too much positive side and good things, and how we use unconventional monetary policy to help to deal with the financial crisis. But what is the disadvantage of use this way? Since U.S. never used a negative interest rate before, the economic scholar just criticized that if we choose to use negative interest rate, it will just instantly break our balance of the economic structure. And this is my reference to how I got this information.
Hello, my name is Jinhui Miao, and I started to impact of unconventional monetary policy on the United States. So when the economic crisis worsened, interest rate cuts are limited, and traditional monetary policy like liquidity, unconventional monetary policy are launched to increase the money supply in the financial system and inject liquidity into financial markets and the real economic to stabilize the market and promote development. So, what are the specific implementation conditions and their impact on the United States? Let us review the global economic crisis of 2008, which is a good case. In 2007, the real estate bubble burst in the United States. A large-scale subprime mortgage crisis caused the U.S. financial market to face a complete collapse, and the United States fall into a deep recession. The U.S. Federal Reserve has cut interest rate 10 times in a row to reduce the benchmark interest rate to about zero. However, the U.S. financial market has not yet emerged from the crisis, but has fallen into the worst recession since the Great Depression. During that period, the Federal used traditional monetary policy to adjust the financial markets, but it was not very effective. At the end of 2007, the Federal Reserve introduced 3 unconventional management toys: term auction financial facility, and a primary dealer credit facility, and a term security lending facility. In 2008, the Federal launched 4 rounds of unconventional quantitative easing monetary policy. So, what does unconventional monetary policy have on the United States? The effect of unconventional monetary policy is difficult to assess, so I will only discuss the performance of the financial market and the macroeconomic after implementation, and analyze the effect of this policy. In terms of financial market, first look at the number of problem banks and the bankrupt banks. After the outbreak of the financial crisis, the Federal Reserve quickly rescued large banks. But after 2007, the overall environment for the bankrupt industry did not improve. The probability of loan default is rising. Assets and liabilities are getting higher, and so on. In 2007, there were 76 problem banks in the United States and only 3 bankrupt banks. Since 2008, the number of problem bank and bankrupt bank has risen rapidly, reaching the highest value in 2010 and slightly falling in 2011. But the number are higher than when the dot-com bubble burst in 2000. And the total number of banks in the United States is declining. The proportion of problem banks and bankrupt banks has also begun to rise, which has a negative impact on the recovery of the macroeconomic. The second is the labor also spread. The interest margin is an important indicator used by economics to measure credit risk, liquidity status, and the pressure in the money market. Increased interest rate indicate low liquidity in the money market, rising interest rate, and a general lack of confidence between banks and banks that do not want to lend. This picture can prove that unconventional monetary policy has indeed played a positive role. Money supply and bank credit. Before and after subprime crisis that broke out in 2007, the size of the base currency in the United States remained about 800 billion US dollar. Starting from QE1 in 2008, the amount of base currency investment increased significantly, about 2 to 3 times as before, but it did not directly create a large amount of money supply. So for the macroeconomic aspects, according to the data released by the U.S. Bureau of Economic Analysis, GDP growth rate in the fourth quarter of 2008 dropped severely. After the implementation of QE1, the downward trend stopped in the first quarter of 2009, and a rebound occurred. It reached around 5% in the fourth quarter of 2009. The change in the fourth quarter of 2009 was large. The fourth quarter of 2010 was about 3%, which was still lower than the level before the economic crisis. Let us talk about the change in inflation. According to the Consumer Price Index, the price fell rapidly from several months in 2009 and began to rise after October. Although it also fell into middle, it remained basically about 2%. It reached 4.57% in February 2011, just like before the economic crisis. So the CPI was maintained at a relatively reasonable rate, and the risk of deflation was reduced. In the unemployment rate side, the unemployment rate in the United States has been rising since the financial crisis. It reached 10.2% in October 2009. After that, the unemployment rate began to decline slowly, but there was also a rebound in the middle. It was still as high as 9.8% in November 2010. After the introduction of QE2, the unemployment rate began to fall, and it fell to 9% for the first time in the first quarter of 2011. Although it started to improve, the unemployment rate was still very high. So for the conclusion, from the perspective of financial market and macroeconomics, the initial effect of unconventional monetary policy is relative obviously, but the liquidity provided by the Federal Reserve cannot solve the problem of the real economic, such as the real estate market, the credit market, and so on. So, all in all, unconventional monetary policy cannot solve all the problems. There should be other policies are needed to revitalize the economy.
Hi, this is Huang Zhaoheng. I'm going to talk about the quantitative easing in QE1, QE2, QE3, and QE4. The traditional conventional monetary policy is weak for an economy to recover from a deep recession. So unconventional monetary policy is used as an alternative. US Fed uses unconventional monetary policy, particularly the quantitative easing, to address why it is important to look at the causes and effect of cause and effect QE1, QE2, QE3, and QE4. And we need to know the use of QE1 was announced on 25th November 2008. The Federal Reserve started buying mortgage-backed securities amounting to $600 billion and $100 billion in other debt. In March 2009, the government announced more $750 billion, $100 billion, and $300 billion to buy mortgage-backed security, Fannie and Freddie debt, and longer-term treasury notes. QE1 was applied in the US as an instrument to revive the economy during the later 2000s world economy crisis. The Federal Reserve had applied conventional monetary policy to the extreme. For instance, the federal fund interest rate was lowered from about 5% in 2006 to 0.25% in 2008. You can see the figure 3. But with no significant improvement in the economy situation, despite the lowering of the interest rates to almost zero. The GDP growth rate declined from about 3% in 2006 to a rate of -4% in 2008. At the same time, the unemployment rate rose from slightly about 4% to 10%. It's therefore evident that the conventional monetary policy has failed. Hence the need for the use of the unconventional monetary policy. The effect of QE1 can be determined by looking at change in indicators such as GDP growth rate and unemployment rate. The GDP rate rose from a decline of 4% in 2009 to about 1% in 2010, and 3% in early 2011. The unemployment rate declined consistently from 10% in 2010 to about 9.5% in 2011. Therefore, it's evident that the QE1 has some positive effect on that growth in GDP and the reduction of unemployment, single recovery, and improvement in the economic situation in the US. And the quantitative easing too is the Federal Reserve implemented QE2 between the November 2010 and June 2011. The Federal Reserve believed that the economy was growing, but not at the expected rate following the implementation of QE1. The Federal Reserve purchased $600 billion in long-term treasury security to accelerate the economy growth. The primary causes of the aim of the implementation of the QE2 is slow in the recovery of the economy. The unemployment rate in later 2010 and the first quarter of 2011 remained high at above 9.5%. The GDP growth rate started declining in 2011, which may have been a negative signal the Federal Reserve need to control the declining and avoiding moving back to the depression by boosting the realized growth from the QE2. The GDP growth rate was 3% in early 2011 and declined during the year to about 1%, the same level as it was in 2010. The QE2, however, seems to have worked as the GDP rate in early 2012 was up to 2.9%. The unemployment rate declined from 9.5% in 2011 to about 8.3% in early 2012. It's therefore clear that the QE2 was effective in controlling the recession, the unemployment rate declined, and the GDP experienced slightly growth. And the QE3 was pursued by the federal government starting on September 13, 2012 and ended in December 2012. The government announced it would be purchasing $40 billion in mortgage-backed security per month until a favorable labor market situation would be achieved. It was an expansionary monetary policy aimed to continue pursuing the realization of favorable economic conditions following the effect of the later 2000 depression. The GDP growth rate had started declining in 2012, hence the need for the intervention. The first effect of QE3 was the decline in the unemployment rate from about 8.3% in early 2012 to about 7.9% in December 2012. Secondly, the intervention assessed in maintaining the GDP growth rate through at 2.5% in December 2012, down from 2.9% at the start of the year. And the QE4 was an extension of the QE3 running from January 2013 and ended in October 2014. The program involved the purchasing of monthly $85 billion mortgage-backed security, an increase from $40 billion in QE3. The first reason why the QE4 was adopted is that although the GDP was growing, the growth rate was declining. In December 2012, the growth rate was 2.5%, down from the 2.9% at the start of the year. Secondly, although the unemployment rate was declining, it remained to be relatively high at 7.9% in December 2012. The federal government therefore wanted to extend the intervention until the favorable economic indicators such as lower unemployment rate, higher growth in GDP, and a controlled inflation rate were realized. The unemployment rate declined from about 7.9% in December 2012 to about 6% in December 2014, which is an indicator of the effect of the intervention. The GDP growth rate rose from 2.5% in December 2012 to about 3% at the end of 2014. Therefore, the government succeeded in reducing unemployment rate and at the same time realized economic growth, which is a positive outcome. The effect could further be explained using the ADS curve. The purchase of the Treasury security by the Federal Reserve leads to an increase in money in circulation, subsequently increasing the aggregate demand, hence the shift in the aggregate demand curve from 81 to 82. From the figure 4, it's evident that the positive shift in the aggregate demand lead to a new equilibrium point, where new equilibrium price and outcome of P2 and Q2 are established. The increase in output level from Q1 to Q2 denote the increased growth in GDP. The increase in the output level implies the increase in the factor of production, including labor, which explains the decrease in the unemployment rate for the intervention period. The unconventional monetary policy adopted in QE1, QE2, QE3, and QE4 had a positive impact on the economic situation in the US after the later 2000 economic crisis. The analysts revealed that the intervention led to an improvement in indicators such as growth in GDP and a decline in the unemployment rate. The ADS curve explained the relationship between the use of quantitative easing and GDP growth and reduction in unemployment rate.